Ladies and gentlemen, good day and welcome to the Cantabil Retail India Limited Q4 and FY25 conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. This presentation, which Cantabil Retail India Limited has uploaded on the stock exchange and their website, including the discussions during this call, contains or may contain certain forward-looking statements concerning Cantabil Retail India Limited business prospects and profitability, which are subject to several risks and uncertainties, and the actual results could materially differ from those in such forward-looking statements. I now hand the conference over to Mr. Vijay Bansal, CMD, Cantabil Retail India Limited. Thank you, and over to you, sir.
Good morning, everyone. On behalf of Cantabil Retail India Limited, I welcome everyone to the Q4 and FY25 earnings conference call of the company. Joining me on this call is Mr. Deepak Bansal, Full-Time Director, Mr. Swendra Nigam, CFO, Ms. Poonam Chahal, CS, and Marathon Capital, our Investor Relation Advisor. I hope everyone had an opportunity to look at our results. The presentation and result release have been uploaded on the stock exchange and our company website. FY25 has been a historic year in terms of performance. We are operating with 600 showrooms now and our company reported highest ever revenue and PAT, setting new benchmarks. The SSG for the year stood at 4%, the achievement of a historical high in revenue and profit after tax. Despite a challenging market environment, is a test to our customer-centric approach, highlights the brand's competitive advantage and its potential for sustainable growth. To further capitalize on the brand acceptance, we have outlined a vision to 2027 of achieving 1,000 crore turnover by FY2027. I now hand over the call to Mr. Swendra Nigam for giving update on the financial and operational performance. Thank you.
Thank you, sir, and a very warm welcome to everyone. Coming to the financial performance. Standalone performance highlights for FY25. Revenue from operations for FY25 grew by 17% to 721 crore as compared to 615.6 crore in FY25. Company reported its highest ever yearly revenue during FY25. EBITDA for FY25 grew by 26% to 205 crore as compared to 162.7 crore in FY24. EBITDA margin for the company for FY25 stood at 28.4% as compared to 26.4% in FY24. PAT for the company for FY25 grew by 20% to 74.9 crore as compared to 62 crore in FY24. PAT margin for FY24 stood at 10.4% as compared to 10.1% in FY24. Here also the company has achieved the higher PAT during FY25. Now I come to the standalone performance highlights for Q4 FY25. Revenue for operation for Q4 FY25 grew by 13% to 219 crore as compared to 194 crore in Q4 FY24. EBITDA for Q4 FY25 grew by 31% to 58.6 crore as compared to 44.8 crore in Q4 FY25. Our EBITDA margin stood for Q4 FY25 stood at 26.8% as compared to 23.1% in Q4 FY24. PAT margin for Q4 for the company FY25 grew by 23% to 22.5 crore as compared to 18.4 crore in Q4 FY24. PAT margin for company for quarter 4 stood at 10.3% as compared to 9.4% in Q4 FY24. With this, we may now begin the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arnav Sakhuja from Ambit Asset Management. Please go ahead.
Hi. Thank you for taking my question. So I see in your Vision 2027 that you mentioned you plan on increasing the store count to 725. So are these stores mostly going to be these new stores are going to be concentrated in tier 2 and tier 3 cities or more in metro cities?
So right now we have a presence of 20% of the stores are in the tier 1 towns, 40% in tier 2 and 40% in tier 3 towns. So same kind of spread we are expecting in the next 2 years.
And what would be the average size of these new stores that you are planning to open?
So last year our average size was 1635 square feet. So it's going to increase a little bit till 1700 square feet per store for the new stores. And for the average store of company today stand at 1300 square feet.
And just one last question. So these newer stores that you plan on opening, are these going to be more ladies, men's stores or a mixture of?
So it will be a mix. Right now, like we have 10% of our store are ladies kids store, 20% are the family stores, 30% are the men's and ladies stores, and 40% are the men's stores. These are our broad classification of the stores. So in the same manner, we will be going forward.
Okay, thanks for answering my questions.
Thank you, sir.
Thank you very much. The next question is from the line of Himanshu Bisani. Please go ahead.
Hello, sir. Thanks for the opportunity. Sir, I actually wanted to understand that our volume growth has been impressive of 15% over the year, but our average sales price has been more or less being constant. So are we selling more of our affordable item, and what does that do to our margins? If you could throw some light on that.
So is increased by 20 rupees when compared to the last year. So we always mention that our USP is our average selling price because we are into the mid-premium segment brand and we are not value brand and not come into the premium segment brand. Because this space at ASP of 1060 rupees is very less crowded. So we plan to be in this space only in the future also.
Yeah, sir, I understand that, but just on that, because our volume growth was higher than our average sales price, so just wanted to understand, is there the range because of the comparatively lower priced products?
So actually what I understood, probably the question is not clear. Our volume is definitely high by 15% and my overall sales is high by, in terms of value is 17%. Right. So it's a mix. It's a slight correction and overall going in the same ratio also. Or any other clarification required?
No, so I understand. So we are more or less planning to be in the higher premium affordable kind of category only, right?
Mm-hmm. Yeah.
Yeah.
So we are positioning ourselves as a mid-premium segment. So we are very balancedly poised in mid-premium segment and going forward also in the same category we are going to operate.
Understood, sir. And sir,
yeah.
With that new target of 1,000 crores by FY27, so that includes a CAGR of 17-18%. So this is
right.
what we
Correct.
have been doing that for last historical years as well. So we plan to be. This is a very realistic target of 1,000 crores. So are we very confident of achieving that, right?
Right. Correct. Absolutely. We are always in the believer of long-term sustainable business. You can check our history as well. So the same number we are going forward. So all the planning is accordingly.
Understood, sir. Thank you. I'll join back in the queue.
Thanks, sir.
Thank you very much. The next question is from the line of Ankit Babel from Shubham Ventures. Please go ahead.
Yeah, good morning, sir, and congrats for a decent set of numbers. A couple of questions, sir. The question was in continuation of your vision statement of 1,000 crores. So what kind of SSGs are you building in while estimating this 1,000 crores revenue for the next 2 years, 26 and 27?
Okay. So, out of this, we are having 5 to 6% target to have the same store sales growth.
Okay. And, the revenue per store, what are your assumptions for the new stores? Because what we have witnessed historically for your company and even other companies, that any incremental store you open has a lower PSF compared to your older stores. So, what kind of PSFs you are estimating for the new stores?
So if you see, we have covered some PSF this year. Last year our PSF was 800, and obviously when the earlier commentary we also mentioned the moment we are opening the bigger store, theoretically per square feet, dimensions has been slightly changed. So this year we end up approximately 785 is our PSF, right? But the average, you just mentioned the average sale per store, that has been improved from last year 116 lakhs to this year approximately 119 lakhs, right? So going forward, approximately 800 rupees per square feet sales we are looking at it, and this absolute number of 119 or 120 is going to be increased.
So, you opened, if I'm not wrong, some 66 stores last year. Okay. And how many stores you opened in FY24?
FY24 net numbers, FY24 was opened 84.
84. So on those 84 stores, what has been the per square feet sales or a per store sales, whatever number you have, compared to the company average? Was it lower? Was it higher? Was it same?
So that we see, there is a maturity period. Obviously, the first year, the sales would not be full for those who have been opened. But overall, it is going to be achieved, as we said, 2 years we are taking to the maturity. So going to the exact number, that is not readily available to me, that I can share with you separately for only those new stores.
Okay, and how's the performance of the 66 stores? I know it's too early, but what are the initial numbers there?
So it's as per the expectations, what we have targeted. So there are no bad stores as such we have to shut down or something was below expectations. It's as per the expectations.
Okay. And sir, how is the consumer sentiment now? Last 6 to 12 months, we have seen some slowdown, in the consumer across the industry. But what we have been hearing was that this quarter is a very good wedding season. So how was your experience in April and May month so far? Did you see some pickup in the demand?
Yes, there is pickup in the demand and there is a positive sentiment and there is positive SSG.
I mean, it's better than the Q4 and the Q3 run rates?
It's better than the Q4, but yes, Q3 Cantabil exceptionally did well. Our SSG was very high. It's below Q3, but better than Q4.
Okay. And what's the outlook on the profitability side, say in the next 2 years, once you achieve this 1,000 crore revenue? Will you sustain your margins at current level, or you feel there will be an improvement or a decline, whatever?
So if you have checked our margin, EBITDA margin this year from last year, we have improved, right? The sale has been improved as well as improved from 25.5% we reach up to 28%. So as we earlier said, categorically we mentioned earlier as well, we have taken a target to whenever reaching the 1,000 crore, we have to maintain our gross margins approximately 56%, and then the EBITDA margin in the range of 28 to 30% is going to be maintained. So that is, there is no, reshaping on the numbers, all on targets.
Okay, so this 28% now is the base for you, and you'll only improve from here on. So we should not be worried about a high base of 25.
Not exactly. We are continuously improving ourselves. So all these are the committed numbers.
And this growth, whatever you are estimating, you believe is can be funded through internal accruals, right? And you don't need any fundraising for that.
Not at all. No, not at all. Absolutely from the internal accruals going forward as well. We are the cash surplus company.
Okay. And the last question is on the inventory side. So, what are the targets here? Is there a scope to reduce the inventory days, or you believe that the current working capital cycle will remain for next 2-3 years?
So the business model what we have, so many times we explained. So this is what the target is. Our 120 days approximately always said in terms of FG we are going to be maintained, right? Last it was 115. Due to some lesser winters, it is slightly on 120, 121 days. But we are never been it is going below 110 days. So we are long-term target is to maintain somewhere between 110 to 115 days. And that is going to be.
Okay. So you'll sustain it at the current levels.
Absolutely. Current level would be sustainable.
Okay. I think, yeah, that's it from my side, sir. Thank you.
Thanks, Ankit. Thank you.
Thank you very much. The next question is from the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good morning, team, and congratulations on a good performance. So my first question is it fair to say that the rent cost for the full year will be closer to about 80 odd crores?
Yes, sir. Ji Bhargav, it is 80 CR.
And the free cash flow post rent and capex will be how much, sir, for the full year?
For this financial year, right, Bhargav?
Yes. Yes, sir.
So if I'll take about post my operational one.
Yeah.
So if I take my post operation, if you are reducing my free cash flow, if you have seen, post net operating cash flows is 148, but that does not include my rentals. So 80 CR of rentals has to be included, to be reduced from this 148. 140 is net of inventory buying and everything. So my net cash flow post operating activities, including my inventory buying and everything. Out of this 148, you need to reduce 80, which is coming in the financing cost, by rentals.
So 60 crore hoga, 60 crores.
Yes, sir. Yes, sir.
Full year.
Full year. Yeah.
Sir, if I look at your employee cost on a per square feet per month basis, it comes to about 160 rupees. So is there a scope to reduce it, or you believe this is the optimum level at which we will operate?
So, yes, employee cost, voice is employee cost per square feet. What you said, Bhargavji? Can you please repeat?
Sir, your employee cost per square feet per month is about 160 rupees, 160.
Right, sir.
So is it possible to reduce it, or ये यही रहेगा मतलब आपके हिसाब से?
Sir, honestly, we are trying to increase, the moment we will get our 5 to 6% of continuous, sales, which we achieved this year, right, also. So slightly it's going to be reduced, but we are not compromising anything in terms of front-end cost. So largely it would be around this only. 150, 160 would have been there, largely.
And out of the total employee cost, what will be the variable incentive in that?
That I need to, in terms of out of 100, because you talked in 160 rupees square feet, so I don't have that readily figure right now available.
Sure.
My overall my store cost, but I can tell you overall my store employee cost versus my incentive proportion is approximately 6 to 7%, 7 to 8%. So you can take it accordingly.
Okay. And lastly, sir, we've seen a good increase in your family stores and ladies and kids stores. So how has been the response there?
Response is good in the family stores. It's as per our expectations, and that's why we are opening the bigger stores now.
Great. Thank you very much for answering my questions, and all the very best.
Thank you, Bhargav. Thanks.
Thank you so much. The next question is from the line of Tanmay, an individual investor. Please go ahead.
Most of my question is answered, so I'm okay.
Thanks, Tanmay.
Thank you so much. The next question is from the line of Srinjanna Mittal from Ratnatraya Capital. Please go ahead.
Yeah, Srinta.
Just give me a second.
The gross margin has increased in this quarter. So is that a mixed impact? Can you throw some light on that?
Your voice was on mute. So can you please repeat the question, please?
Yeah. So I was saying that the gross margin has increased in this quarter. So is that a mixed impact? Can you throw some light on that?
So basically, gross margin has been increased by 2%, 2 or 2.5%, right? So majority, it is by the slight increase in the correction in the prices.
Sorry, the gross margin is increased, so that would be a mixed impact or the lower discounting? So that was my question.
Discounting we have controlled to the lowest, very slight portion of discounts, but there is a significant portion of correction in prices for this 2% only.
It's on the cost side.
2%. Yes, cost side.
Okay. Understood. And the second question was on SSG. So this quarter, the SSG was negative 1%, right? And last quarter, the SSG was 18%. So what is driving the SSG for us? And what are your thoughts on we are targeting 5 to 6% of SSG, but if we look for last 5-6 quarters, the SSG that has been on the lower side, except except the last quarter. So what are your thoughts on the SSG part?
So our overall target is to be taken on an annual basis. We are going to achieve on an annual basis. Maybe a quarter due to headwinds of other things as well. Like this quarter, we were going very well, but the immediately sudden post of the summer came early, right? So we have never seen a 2 months gap in summer and Holi. This time it was there. So these kind of exceptions would be there. But overall, our target is to keep the 5 to 6% on an annual basis, and that will be achieved. Maybe few quarters may be up and down, but overall annual target we are working, and that is achievable.
Understood. And what is which factor plays a role here in the seasonality aspect? Is it primarily the wedding season, or is it just general retail demand? Or is it mixed? What is your take on that?
There is two factors majorly, the season and the wedding season. Season, I mean, the winter season was very poor in the Q4. That's why our SSG has gone down. So season has an impact, and the wedding season, the number of wedding dates has an impact on the sale growth and the same store sale growth. So these are the two major factors. The rest are the force majeure kind of conditions. That is the one we just seen in the war time now.
Understood. Okay. Just one last question. In this year, were there any stores which were closed? If you can give the number of count.
So, yes, that is store closure, right? What you asked?
Yeah, store closure in this year.
66 opening is our net number, because we are having a huge number of stores now. There are 600. So obviously now the leases for the stores are coming for more frequent leases are coming for the renewals, right? 5 to 10% leases are coming for the renewals, right? So out of this 16, overall closure in terms of stores was 18. Performance-based closure was 8, right? And 10 were the relocations.
Okay, so 10 were out of the 18, 10 were relocated, and rest 8 was
the closures. Yeah.
And these 8 stores, they were not profitable stores. And how old were these stores? Some can give just on an average some light on that.
The one which we closed down.
No, 8 stores.
Okay, the one we closed down is generally the outdated kind of stores where the markets get outdated or the sales have dropped a lot in the recent past. So that kind of places we used to shut down majorly. There are only very few stores which have rental revenue ratio gets very poor, we have to shut down. So there are some malls which get outdated. There are some markets which get outdated with the passage of time, and we don't renew the store there, and we close the store there.
Understood. Thanks for taking my questions and all the best. Thank you.
Thank you.
Thank you very much. The next question is from the line of Rajesh Jain from Jinanand Research. Please go ahead.
Hello. Yeah, thank you for the opportunity, sir, and congratulations for the good FY25 numbers. I have a couple of questions. The first one is that despite good operating cash flow generation by the company has not declared any dividend. Any specific reason? And the second one is in accessories, where more categories would have been near-term focus areas. Company do have any plan for entering into accessories in women's segments, like beauty products and other things?
So two questions you asked. First question, I'm replying for dividend. So we have a very clear dividend policy, and up to 20% we are distributing. So one interim dividend has already been declared and paid post the result of Q3, and the final would be declared probably in the AGM. So that is very clear policy. Year and year you can see. Your next question regarding accessories.
You are telling about the accessories and the cosmetics parts in the women category. So right now we don't have plan to go into the cosmetics or the beauty products. So we will be only going with the accessories category we are already doing.
Okay. Thank you very much, and best of luck, sir.
Thank you, Rajesh. Thanks.
Thank you very much. The next question is from the line of Yogesh Bhatia from Sequent Investment. Please go ahead.
Yes, sir. Congratulations on good set of numbers. So I want to know, do we categorize our sales in the different segments that we have, kids wear, men's wear, women wear?
Yeah, so overall contribution is like this. 81% of the sales is coming from the menswear category, 11% is coming from the women's wear category, 5% from accessories, and 3% from the kids wear.
Okay. So going forward, when we are looking at this, vision of 1,000 crore, how will this shape up? And is there a plan to, get into individual stores for women, or it is going to be a mixed store? What is the strategy on that?
So right now we have 10% are the ladies and kids exclusive stores. So we broadly will manage it around 10 to 12% only. And ladies' contribution, the total sales will increase a bit. Like it's 11%, it can go into 13% in a year or two.
Okay. And do the margins remain the same in the same lines, or the margins are different in different categories?
Margins are almost the same in every category.
Margins are almost the same. Okay. Thank you, sir. That should be all.
Thanks, sir. Thank you.
Thank you very much. The next question is from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi, sir. Thank you for taking my question. So my first question is if you could give us some sense on what is our mature store sales, PSS.
So right now our sales is like 785 per square feet.
No, sir, that is at a company level. I wanted, the difference in mature stores and, the newer stores. What PSS are the mature stores sitting at?
So right now we don't have the specific data of the last year, because one more question came almost the same, that what was the average sale of the stores open in 2023 and 24. So we can share you that specific data later on.
But sir, generally, what is the PSF for mature stores? That's the only data I want.
That's the only
indicative range.
Yes, 800 is there, but we have a 1.2 CR of average. But when I'm categorizing my stores for more than 3 years or more than 6 years, so there is a 10 to 15% is the difference, right? So few very old stores are average is delivering 150 lakhs, and few are delivering 1 CR, which is new. On that basis, 10 to 15% is the difference in terms of per square feet sale also for the matured store as well as old stores.
Got it, sir. So my second question is, are we seeing the rental escalations or rental cost increasing for our newer stores? And along with that, is our CapEx per store going to increase as we are opening larger size stores now?
So CapEx in terms of absolute cash flow, yes, definitely going to increase because my per square foot CapEx of 1,700 rupees remains same for last 2-3 years. Last year it was approximately same, this year also. But since we are opening the bigger stores, so definitely overall CapEx outflow for next financial year in terms of opening more high as well as renewals are also there. So we have allocated 25 to 30 CR. My CapEx will go in opening of the stores and renovation of new stores.
But regarding the rentals, per square feet rentals are going down. So last year it was 129 rupees square feet. Last year it was 122, and this year it has came down to 120 rupees square feet. So per square feet rental is going down due to the bigger store because per rental cost per square feet is lesser in the bigger stores.
Right. Got it, sir. So my next question is, if I look at our SSG growth over the last 3-4 years, every year, it's been very volatile. So I just wanted to ask, what are the initiatives that we are taking to, get consistent SSG growth?
So we have majorly going for the staff motivation programs, and staff motivation programs have really worked very well. And our SSG is volatile when there was a phase of COVID. If you remove the COVID phase, our SSG was like average SSG of last 4 years was 5% only if you remove the COVID phase. So SSG in the quarters you can say was a volatile, but when you take the complete year, SSG was stable.
So last year was the exception. We are the first time we have faced that because the market was really challenging. So we have did better and only -4% last year. So if you see the historical data also, it is 5-6% constant basis SSG there.
Right, sir. So my next question is, we are targeting 1,000 crores of sales. I just wanted to ask if we are prepared for it on the back end, in terms of manufacturing capabilities and the corporate, corporate level and warehouse that we would need. So are we prepared for that, or we would have to spend some of the capex on these things also?
So I'll explain you my total capex plan, what is there for next financial year going forward also. So we are absolutely ready for all these things because we are just looking at the 1,000 crores is just done, right? So we don't need much changes in our system or any of the backend thing. As far as capex is concerned, as you asked, so our warehousing cum corporate facility is going to be complete by end of this calendar as well. So there is an outflow of 13 to 14 CR remaining, which is going to be there. We are enhancing Bahadurgarh facility as well. One floor is being constructed there. That is required approximately 8 to 10 CR. And as I just said, the 30 CR is required. So total capex requirement is 50 to 52 CR for this financial year, right? Which completes all my requirement of 1,000 crore, not we are more than double it from the 1,000 crore.
Got it, sir. Got it. That's it from my side. Thank you.
Thank you, sir.
Thank you very much. The next question is from the line of Yash Bajaj from Lucky Investments. Please go ahead.
Hi. Good afternoon, sir, and congratulations on a good set of numbers. Sir, my first question was on the franchisee-led expansion. Last year we had kind of has kept ourselves back from expanding from the franchisee route. Any thoughts regarding that in the current financial year, considering the retail environment has become more favorable now?
So franchisee, only total company proportion is right now 20% of the franchisee stores and 80% are the COCO stores. But regarding the new stores, the ratio is further less. So in the last year, we opened 66 stores. So 61 were the COCO stores and the 5 were the franchisee stores. So approximately around 10% were the franchisee stores. So same kind of thing is going to be there in future.
Okay, got it. And my second question is regarding the gross margin. You alluded that there was, because of better pricing, there was a gross margin improvement this quarter. But sir, the ASP has been flat or slightly lower on a year-on-year basis, both for the quarter and the financial year. So, Is there any other reason for the gross margin improvement? Because like you said that
ASP has increased in the quarter also and in the yearly data also. So there is 1% increase in quarter and 1% increase in the year for the ASP.
But that would not lead to a 200 basis point improvement in gross margin, right? Is there a raw material? Is there a raw material deflation? Anything around that?
So overall, if I say my gross margin improved probably by 2%, right? So there is a very slight percentage there in terms of controlling the discount, but mostly the correction, and there is a very small amount of portion in the price in terms of controlling of the buying price as well. But largely it is driven by slight corrections. So 20 rupees, if you calculate the ASP by multiplying into the number of pieces what we sold, it is coming to those approximately those numbers only. 65 lakh pieces we sold at ASP, if you calculate, largely it is coming to near to that number.
Okay, fine, sir. Okay, got it. And so how much did we spend this year on advertisement and branding?
1.32%, sir, is the total expenditure this year as compared to last year, approximately 1.6%. So we are controlling it now and.
Okay. And last question, how much was our online sales this year?
So we closed this year 6.2%. So as far as total sale from online.
6.2%. And how has that grown, sir?
44-45 crore is largely the number for online sales out of 720.
And what was the number for the financial year 24?
33.
Okay.
33 CR, 44 crore closed this year as compared to 33 CR online sales last year.
Okay, got it. That's all from my side. Thank you and all the best.
Thanks, yes.
Thank you very much. Participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Arpan Rathore from Inside Advisory. Please go ahead.
Good afternoon, sir. First of all, congratulations on a very good set of numbers and also outlining a vision statement so that everybody can track. Essentially, my first question is coming on the vision itself. You have outlined that you will be reaching 1,000 crore top line by FY27, which essentially translates into a revenue growth of 13 to 14%, which is lower than what you're currently doing. Any specific reason why we are estimating a lower number?
Sir, it is coming approximately 18%, what we are tracking. 720 we closed this year. If you add up 17 to 18% in next 2 financial year, so we are achieving 1,000 crore.
Mm-hmm.
So this is not 13%, this is 17-18% approximately.
Yeah, but still it's a little lower than your current growth rate. So is it a conservative number for us or?
So this year also, sir, we closed at 17%. Last year also was the same number, except if you remove the COVID number. So these are the long-term sustainable number. What we have, maybe it will be a couple of percentage more, but as of are the achievable numbers.
Okay. Also, in terms of volume, you have guided for an SSG, a higher single-digit SSG. In terms of volume, is there any number which we have thought through that we will be growing by such and such volumes?
So 50-50 always we said, like this year 4% and 2% of volume being driven. So going forward, when I'm talking about 5 to 2 to 3% would be the volume, and some correction would take it to 6%.
Okay. My next question is on the gross margin. We've seen COGS reducing on just quarterly basis on a yearly basis. Don't want to go into the details of it, but what would be the sustainable gross margin going forward?
So when we are going forward and achieving 1,000 crore numbers, some more portion of e-commerce will go, which will dilute little bit of margin, but it will never go less. So always 55 to 56% is the target. It is going to be 55, 56, 57% approximately. Not less.
Great. My next question is on women category. In terms of sales, you mentioned that it contributes around 18%. My question is more on a strategic perspective. We don't see any credible women wear brand. Don't we see a scope to enter that territory and capitalize further on the brand image which we already carry? Any thoughts on improving the women wear contribution in our overall sales?
So right now, women wear contribution is 11%, and as I mentioned, we want to improve it to 13%, and we are opening new ladies and kids exclusive stores also. So last year, 10% of the stores which were new opened was the exclusive ladies and kids stores. And in the men's, in the family stores and the men's and women's stores also, there is a portion of women's category. So definitely, women's proportion is going to increase in the coming years.
Okay, great. My last question is more on balance sheet. The working capital there's been slight increase, though 1 or 2 days to 114 days. Wanted to understand what would be the targeted level, or should we assume that 110 to 115 is the targeted range from a company perspective?
Absolutely, sir. You answered the question itself. So long-term target is we are 114. Last year also it was there in terms of working capital. So considering my business model, it would be approximately 110 days.
Okay. And another question on margin. Coming back to the margin question. So we have guided for a higher single-digit SSG growth. Do we see EBITDA margin improving on account of that? Or that 28 to 30% is the guided range. Do we see a scope of improvement further from there?
Still, we improved from last year to this year, if you say. We improved 2% approximately. So going forward, 28 to 30% is a very reasonable number, which in the current tough market we are able to maintain. So going forward, 28 to 30% is a target for EBITDA margin as well.
Sure. That's it from my side. Congratulations once again.
Thank you, sir.
Thank you very much. As there are no further questions from the participants, I now hand the conference over to Mr. Deepak Bansal for closing comments.
I would like to once again thank all of you for joining us on call today. We hope we have been able to answer your queries. Please feel free to reach out to our CFO or IR team for any clarification or feedback. Thank you all.
Thank you, everyone. Thanks.
Thank you very much. On behalf of Cantabil Retail India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.